Take a look at the Chapter 6 problems. I've just got the screen open to our ebook, just looking at the computational exercises for Chapter 6 where I'm at. So up here it says Chapter 6, and then I've got question 25, the first computational exercise. I'm going to go through all the computationals and a couple of the problems, just so you know. Okay, so for the first one, we're looking at during the year Natcatcher, if I can say that right. They have EMP of $1 million, distributed $200,000 each to Brandy and Ewan in redemption for some of their Natcatcher stock. The two shareholders acquired their shares 5 years ago. Each shareholder has 33% tax bracket. Each has a $45,000 basis. Assuming the distribution of Brandy's a qualifying stock redemption, determine Brandy's tax liability on this. And you can see for Brandy, this is a pretty straightforward one, by the way, which is kind of nice when they first start us out here. Brandy's tax will be $23,250, and it's a qualifying stock redemption, so its tax is a sale or exchange. And so it's a long-term gain, and so what you do is you take the $155,000, which is the amount realized, so the $200,000 distribution, minus the $45,000 basis is $155,000, and then multiply that by the long-term capital gain rate of 15%, and you get $23,250. For B, it's Ewan. Now we're saying it's non-qualified. So what's the difference? Really, this is a good problem to illustrate the difference between a qualified versus a non-qualified and how that works out. So because of this one being non-qualified, it's basically treated as a dividend. So the entire distribution is treated like a dividend, $200,000 dividend, and the rate would be 15%, being in this 33% tax bracket. And so Ewan would pay 15% of the full amount of $200,000, which is then $30,000. Okay, so it's just a good example of qualified versus non-qualified and the differences between the two. Okay, question 26 is Rosalie has a Rosalie owns 50% of the outstanding stock of Salmon. In a qualifying stock redemption, Salmon distributes $80,000 to Rosalie in exchange for 1/2 of her shares, which now have a basis of $100,000. Compute Rosalie's recognized loss, if any, on the redemption. And you can see here how this one works out is for Rosalie, it's a qualifying stock redemption. That's the key thing. Hopefully everybody saw that. And because it's qualifying, it's treated as a sale or exchange. Okay. Since Rosalie does not own more than 50%, she owns exactly 50%, but not more than 50% of the stock at the time of the redemption, Section 267 does not apply to disallow a loss recognition, so just be aware of that. So the answer is that she recognizes a loss of $20,000, $100,000 basis, and then the $80,000 fair value, $20,000 loss, and so that is what she gets. So you cannot disallow the loss recognition under Section 267, and it is a qualifying stock redemption treated as a sale or exchange. Okay, 27. Dirk owns 250 shares of stock in Rose. The remaining 750 shares of Rose are allowed as follows: 150 by Dirk's daughter, 200 by Dirk's aunt, and 400 by the partnership in which Dirk has an 80% interest. Determine the number of shares that Dirk owns, either directly or indirectly, in Rose Corporation. So with this one is just really trying to figure out, what does he own? So Dirk has a 250 direct. We all know that. So that's an easy one. He also controls the 150 owned by his daughter. Okay, so immediate family, daughter. Then he also controls 80% of that partnership, and the partnership owns 400 shares. So 80% of 400, everybody should see that's 320, if you do the mental math there. So it's 250 plus 150 plus 320 for a total of 720. For 28, Indigo, let me get the whole thing on the screen here. Indigo Corp, there we go. Wants to transfer cash of $150 or property worth $150 to one of its shareholders, Linda, in a redemption that will be treated as a qualifying stock redemption. If Indigo distributes the property, the corporation will choose between two assets that are each worth $150 and are no longer needed in the business. A property A with the basis of 75 and B with the basis of 195. So basically the question is going to come down to which one makes the most sense. We'll look at it from three different directions. For letter A, compute Indigo's recognized gain or loss if it distributes property A in a redemption of her shares. So property A had a basis of 75, and so with this one is pretty easy. You just basically, it's the $75,000 gain. Because the fair market value is 150 minus the basis of 75, and so we have a gain of 75. And here's the rule behind that one. Distributions and redemption of stock are governed under Section 311. Under that provision, gains but not losses are recognized on the distribution of property. So she gets a $75,000 gain. For B, this is Indigo's. When I say she, I actually should be talking about this from the perspective of Indigo. For property B, compute Indigo, or I'm sorry, section, if I can talk here, B, which is property B, compute Indigo's recognized gain or loss if it distributes property B in redemption of Linda's shares. So this one then, a little bit different story because we've got the 195 basis and the fair market value of 150. So obviously it's a difference of 45. So a little bit different story here. This is a loss, a $45,000 loss. However, this loss is disallowed. This qualifies as a Section 311 loss. Gains but not losses are recognized on the distribution of property. Okay, so a disallowed loss of $45,000. Letter C says compute Indigo's recognized gain or loss if it sells B to an unrelated party, then distributes the sales proceeds back to Linda. So we're going to sell property B and then give the cash to Linda. And this is pretty easy. This would be a loss because we're selling a property worth 150. We're assuming we're getting the 150 for it. The basis was 195, so we took a loss of 45. So from the company's perspective now, they can take that loss as a recognized loss of 45. So clearly that's an option that would be the best for them. Okay, 29. Caramel Corp has 5,000 shares of stock outstanding in a qualified stock redemption. Caramel distributes 145,000 in exchange for 1,000 shares. At the time of redemption, Caramel has a paid-in capital of 800,000, E&P of 300,000. Calculate the reduction in their E&P as a result of the distribution. It's reduced by 60. Okay, reduced by 60, and it's a lesser of the 145 distribution, or the 60,000 ratable share of E&P attributable to the stock redeemed. Okay, and so what we do to calculate that is we take 300,000, the 300,000 E&P, times 20%, and the 20% is 1,000 divided by 5,000. Okay, so they had 5,000 outstanding. We're exchanging or redeeming 1,000 shares. That's 20%. So 20% of 300,000 is 60,000, and we go with the lower of the 60,000 or the 145 distribution amount. So the 60,000 is lower than 145, so we go with 60,000. Okay, number 30, it says dividend income of 120 in a non-qualified stock redemption. Oh, I'm sorry, I'm reading the wrong thing. Question 30, Sunset Corp with E&P of 400,000 makes a cash distribution of 120 to a shareholder. The shareholder's basis on the stock is 50. Letter A, determine tax consequences to the shareholder if the distribution is a non-qualified stock redemption. Non-qualified. So, question 30, letter A. For this one, dividend income is 120. In a non-qualified stock redemption, a distribution is treated as dividend income to the extent of the distributing company's E&P. Okay, and so they've got E&P of 400,000. They're distributing 120. We treat it like a dividend because it's non-qualified. Letter B, determine tax consequences to the shareholder if the distribution is a qualifying stock redemption. Different story now. Now, because it's qualifying, we look at the 120 and we subtract out the basis of 50. So now we have a $70,000 gain. Okay, so 70,000 gained. 120 of the distribution minus the 50,000 basis is 70,000. Letter C, determine the tax consequences of the shareholder if the distribution is pursuant to a complete liquidation of sunset. And the answer is still a capital gain of 70, just like it is with B. A liquidating distribution results in sale exchange treatment, thus the 120 amount is realized minus $50,000 stock basis for a gain of 70. So we're treated the same between B and C. We treat them the same. Letter 31, pursuant to a complete liquidation, Carrot Corp. distributes to its shareholders real estate held as an investment, basis of $650 with a fair market value of $880. Determine the gain or loss recognized by Carrot on the distribution if no liability is involved. So no liability is involved in letter A. And this one is a gain of $230, which is the fair market value of $880 minus the $650 basis. Gain of $230. So letter A, gain of $230. The distribution and complete liquidation generally results in a recognized gain or loss as if the property were sold for its fair market value. Letter B, determine the gain or loss recognized by Carrot on the distribution through real estate is subject to the liability of $690, or to a liability of $690. So now the only difference is this property is subject to a liability worth $690. And in this example, it's still a gain of $230. The gain recognized is $230. If the property is distributed subject to a liability, the fair market value in the deemed sale cannot be less than the amount of such liability. Okay, so the fair market value is above the liability, so we still recognize the gain of $230. Letter C will change that around though. Determine the gain or loss recognized by Carrot if the real estate is subject to a liability of $885. So now the liability is $5,000 higher than fair market value. So a little bit different. In this example, the gain recognized is $235. So it's $5,000 difference. And if the property is distributed subject to a liability, fair market value in the deemed sale cannot be less than the amount of the such liability. So the liability is $885, which is more than fair market value of $880. And so what we do is we take the $885 liability and we subtract that from the basis of $650, and then we get a gain of $235. Okay, so that's the only difference is when the liability was above fair market value, we subtracted basis of $650 from the liability to get the $235 amount. So $230, $230, and $235. This last one just recognizing that the liability is higher than fair market value. Okay, 32. 32 is Osprey Corp. They own stock, is owned by two people, Pedro and Pitro. They are unrelated. Pedro and Pitro each own 50%. Osprey has the following assets, none of which were acquired in a Section 351 or contribution to capital transaction, that are distributed in complete liquidation of the corporation. So they've got cash, land, and equipment. The land and equipment, of course, have different bases than fair market values. Assume that Osprey distributes land to Pedro and cash and equipment to Pitro. Letter A, determine the recognized gain or loss on the distribution of the land. Remember that Pedro is receiving the land. This one's pretty simple, just simply a gain of 240 on Osprey. It's a liquidating distribution, results in recognized gain or loss if the property were sold for its fair, as if the property was sold for its fair market value. So it's liquidating. We just take the 440 minus 200, we get a 240 gain. So letter A is 240 gain. Letter B, a little bit different story because fair market value now is below the basis by 110. And for this one, it's just simply a loss of 110, again, because it's liquidating. So generally, in liquidating distributions, the result is a gain or loss. And so in this example, it's a loss. In the first one, it was a gain. Also, just know that the related party loss limitation does not apply. They mentioned that the two parties are not related. It's not subject to the more than 50% shareholder-related party rule. The built-in loss limitation does not apply also, as the property was not acquired in a Section 351 or contribution to capital transactions. So built-in loss limitation does not apply with this one either. So it's a very straightforward one. They're kind of just telling us, here's a straightforward example because these other things don't apply. Okay, number 33. With 33, we have Martin Corp. Acquired two properties from a shareholder in a transaction that qualifies under Section 351. So now we are under 351. The shareholder's basis, fair market value, built-in gain or loss for each property are listed below. You can see what those numbers are. Martin adopts a plan of liquidation later in the year and distributes property 2 to a 30% shareholder when the property is worth $350. Compute Martin's, letter A, compute Martin's basis on property 1 and 2 as of January 4/16, the date of this, the numbers up here. Okay, so for letter A, we have a carryover basis, and so Martin has a carryover basis of $300,000 in property 1. For property 2, the basis step-down rule applies. Martin's basis in property 2 is $475. So this one here, because fair market's above the basis, we're good. $300,000 is the basis. But for property 2, we know that we have a loss here, and so we need to do the step-down basis. So the basis now becomes not $525, but it becomes $475 because we've got a $525 carryover basis minus a $50,000 built-in loss, the $400,000 minus the $350. We subtract that built-in loss of $50, and then we get the $475 as my new basis. For B, compute Martin's realized and recognized loss on the liquidating distribution of property 2. So Martin has a realized loss of $125, which is the fair market value of $350. That's the new value right here, $350, minus the step-down basis of $475. So that's $125 loss. Okay, so it looks like 125 as you look at these numbers, but it's still 125. But the answer is 475 minus 350 to get down to the 125. Just some notes about that. The built-in loss limitation applies to disallow the loss that was inherent in the property on the date acquired after considering a step-down basis rule, or $75,000. Yeah, I think we can stop right there. So it's just 125, 475 minus 350. Okay, number 34. Green Corp. Assets are valued at $920 after payment of all corporate debts except for $134 tax payable and net gains it recognized on liquidation. Bruno as an individual, and the sole shareholder of Green has a basis of $280 on stock. Compute the gain or loss recognized by Bruno on the liquidation of Green Corp. And that one's very straightforward. And so it's the fair market value of 920 minus the tax liability of 134 minus the 280 basis. So 920 minus 134 minus 280 is a $506,000 gain. 35, the stock of Quail Corp is held as follows: 85 by Pheasant and 15 by Gisela. Quail Corp is liquidated in December of the current year pursuant to a plan adopted earlier in the year. At the time of liquidation, Quail Corp has assets with a basis of 730 and fair market value of $1 million. Quail Corp distributes the property pro rata to Pheasant and to Gisela. Compute Quail's recognized gain or loss on the distribution, and then compute Quail's recognized gain or loss on the distribution to basically A is to Pheasant, B is to Gisela. Let's look at letter A first, of course. So for letter A, the key thing here, it's a parent-sub relationship, 185% owned sub. And so because of that, it's governed by Section 332. Quail, the sub, recognizes no gain or loss on liquidating distributions to Pheasant, the parent. Letter B, a little bit different story now. We'll have a gain. With this one, we're going to have a $1 million fair market value minus the $730,000 basis. And so that gain of 270, then we multiply it by 15%. Okay, the 15% ownership. So 270 multiplied by 15% ownership, and the answer then becomes 40,500. So Gisela is a minority shareholder. In liquidation otherwise subject to 332, sub corp recognizes gain but not loss in the distribution of property to a minority shareholder. Okay, so Quail will recognize then a gain because to the minority shareholder of $40,500. Okay, question 36. Blush Corp owns long-term bonds basis of $1.3 million of its sub, Brass, that were acquired at a discount. Upon liquidation of Brass pursuant to Section 332, Blush receives a distribution of $1.5 million. The face amount of the bonds determine Blush's recognized gain or loss on the distribution. So thankfully this one's pretty straightforward. It's a gain of $200,000. You can see the cash is $1.5 million. The basis is $1.3 million, so $200,000 gain. And Section 332 non-recognition treatment does not apply to distributions received by a parent corp in satisfaction of indebtedness of a subsidiary. So Section 332 does not apply. So even though it says it does here, it's because this was repayment of a debt. Okay, so that's the unique thing about question 36. Okay, question 37 says Goose Corp has a basis of $2.4 million in the stock of Swift Corp, wholly owned sub acquired 30 years ago. Goose liquidates Swift Corp and receives assets worth $2 million with a basis of $1.7. Letter A, determine Goose Corp's recognized gain or loss on the recognition. Goose recognizes no gain or loss under Section 332. Goose's basis in the Swift stock will just simply disappear. The $2.4 million basis just goes away because it was Section 332, no gain or loss. Letter B, determine Goose Corp's basis in the assets received in liquidation. Goose has a carryover basis of $1.7 million in the assets received in liquidation. So this get a carryover basis of $1.7 million. Okay, just a couple of problems I'm going to go over with you too here. Questions 38, 39, 40 are the ones I'm going to go over. Actually, 38 through 43. And tell you, I'm going to just do this in a separate recording. So I'll just stop here and